Hi everybody, my name's Ben McGarry and I'm the founder of Totus Capital and the lead fund manager on our Totus Alpha Fund. Welcome to our 2020 year in review and outlook for the Totus Alpha Fund. The objective of this webinar is to provide you, our valued clients, with a relevant update on Totus Capital with a focus on our Alpha Fund. 2020 has been a wild ride in markets, and without face-to-face meetings, it's been a challenge to keep investors as informed as we have done in the past. We believe that transparency is more important than ever this year, so this presentation is our attempt to give you, our valued clients, all the context and information you need. In this webinar, you will hear firsthand how we approached 2020, and I'll share with you not only what worked this year, but what didn't and what we can do better. It's also an opportunity for you to better understand how we see things moving forward. We'll talk about the current major themes in the portfolio and areas of focus for our research and highlight a few key stocks from the portfolio. This should help you walk away with an understanding of where we see the best opportunities for the long term, and importantly, how our process positions us in the highest quality companies with direct exposures to those opportunities. Many of you know the Totus Alpha Fund and Totus Capital, but for those who don't, we're an independent fund manager based in Sydney, established in 2012. Our philosophy is that high quality businesses experiencing tailwinds with proven track records and an absence of red flags will outperform a basket of low quality businesses facing challenges and headwinds over the medium to long term. We believe that a carefully researched portfolio constructed on this basis should deliver uncorrelated returns and a degree of downside protection for portfolios in falling markets. This has been the case over the last 8 years, and we see no reason to believe that it won't continue to be the case going forward. We have two funds here at Totus, the Totus Alpha Fund, our long-short offering, and the Totus High Conviction Fund, our long bias fund. Our investment team is highly aligned with our investors via a significant personal investment in both funds. Staff and family currently account for just over 7% of Totus assets under management. As founder of the business, I'm the lead portfolio manager on the Totus Alpha Fund and co-PM of the Totus High Conviction Fund. In the investment team, I'm ably supported by Sam Granger, who is co-PM of the Alpha Fund and also lead portfolio manager of the Totus High Conviction Fund. Our analyst is Tim Warner. Our focus today is on the Alpha strategy. Started in 2012, the Alpha strategy has achieved just over 14% per annum returns net of fees since inception, roughly 5% ahead per year of the ASX 300 accumulation index, including dividends. Our focus is not just on achieving strong returns in the Alpha Fund, but achieving uncorrelated returns. The key point of difference for the Totus Alpha Fund is downside capture, or our performance in markets that are falling. The Alpha Fund has delivered positive performance on average in ASX up months, but has lagged the market in those up months. But importantly, in ASX down months, the Alpha Fund has also delivered positive returns. The average fall in the ASX in a down month since inception 8 years ago is over 3%, and the Alpha Fund's performance during those down months has been a positive 0.9%. The Alpha strategy is open to both wholesale and retail investors. The Totus Long Short Fund, the retail version of the Alpha strategy, received a 4-star high investment grade rating from SQM Research in November 2020. The webinar today will focus on 4 key areas: a year in review, current themes and areas of focus for the fund, stocks of interest, and we'll address some key questions that clients have been fielding to us recently. At the end of this session, you should walk away with a deeper understanding of our thinking and, importantly, confidence that we are well positioned to make the most of the opportunities in 2021 and drive results for you, our clients. We hope that you find the next 30 minutes informative, and we're more than happy to share the slide pack with you as required. In this section, we'll share with you the key drivers of our performance in 2020 and the lessons we've learned along the way. We view 2020 in 3 parts: COVID and the market sell-off, then the recovery, and more recently the rotation post the US election and the vaccine announcements. On the first chart here, you can see that despite drought and bushfires, the market got off to a strong start in 2020. But then COVID hit and the market sold off. Markets fell 24% and the fund was up 12%. The portfolio did its job and we delivered strong absolute and uncorrelated returns during a difficult period for portfolios. The GFC playbook worked in Q1. Quality outperformed, strong balance sheets outperformed, the Aussie dollar fell. Our portfolio has always worked well during sell-offs, but this was a solid test of it. It works, and that's the key reason you invest with us. Downside capture is core to our value proposition and will remain so in 2021. Secondly, the recovery. We all know how hard markets rallied since April. Central banks acted fast and removed liquidity as an issue for markets. Governments also stepped in and with stimulus, which reduced the risk of unemployment and threw struggling businesses a lifeline. We moved to get longer. We bought dips in high quality businesses like Visa, MasterCard and Microsoft, which were caught up in the broader sell-off, but which we saw as longer term beneficiaries of the pandemic. We covered shorts. However, as the rally continued to build, it was clear that we had not moved quickly enough or hard enough. As you can see on these slides, our longs have performed well, but our shorts have been the drag since April. The prospect of zero interest rates and unlimited central bank support have meant that the market was able to give unprofitable and potentially unsustainable businesses the benefit of the doubt and began assuming never-ending access to funding and an extremely long runway to succeed. Fiscal support for impacted workers, as well as the suspension of certain directors' duties and obligations to pay things like interest and rent, kicked solvency issues down the road, and as a consequence, there were very few catalysts for our short book to work. Investors piled into popular stocks like Afterpay and Tesla. The rise in market caps in these names took access to funding, which was a key leg of the short thesis, off the table. We learned two key lessons during this period. Take profits on shorts after market falls. Our biggest winners in Q1 turned into our biggest losers in Q2. We needed to get longer in the market sell-off and be more aggressive in taking profits on shorts into market sell-offs. As a result, we've made some minor adjustments to our process to ensure we don't make the same mistakes again. We've implemented a 5% hard limit on shorts. We now have a range of alerts set up on the portfolio that show when our short positions start to move against us. These are not hard stop losses, but are calls to action for the investment team to do something, reduce the position size or take profits on positions that have worked. The second lesson was a hard one. The chart on your screen shows our single stock attribution this year. Two stocks stand out. Tesla and Afterpay together cost the fund 10%. These are our largest two losses on short positions in the history of the fund. These stocks ticked virtually every box in our process for selecting shorts. Poor cash flow generation, a heavy reliance on external markets for funding, insider selling, staff turnover, etc. So what went wrong? Our internal postmortem came up with one common denominator: a great product. In future, we will think long and hard about shorting any company with a great product and a cult-like status amongst its customers and investor base. Thirdly, to finish 2020, we've seen the post-US election, post-vaccine announcement rotation from growth into value. Readers of our monthly performance updates will know that we've been gradually increasing our net exposure all year. We wrote in our October monthly that we expected that with the US election out of the way and vaccine announcements on the horizon, the setup was strong for equity markets into Christmas. What we have seen post the announcements is that the pandemic winners, of which we've been long quite a few, have been sold to fund a rotation into the perceived recovery plays. A strong kick up in the Australian dollar has also been a headwind for our portfolio, given the weighting of US longs in our book. In recent days, we've started to see some unwind of this rotation. November reminds us a lot of the Trump election win in 2016, which was another tough year for our strategy, but saw the start of a recovery in December and set us up for a strong year of returns in 2017. In summary, 2020 has been an exceptional year. COVID and the market sell-off, the portfolio did its job and delivered meaningful absolute performance. Then we had the recovery, where we haven't performed as well as we would have liked, but we've learned some hard lessons from this period and adjusted where we needed to. The more recent risk-on period and rotation post-vaccine announcements in the US election. We've seen this all before. Fundamentals and business quality matter over the long term. Rotations come and go in the short term, but we are well positioned to deliver for our clients in 2021. I will now explain why. In this section, we will share with you the key market themes we are focused on at the moment and some of the companies in the portfolio with strong exposure to those themes. As we work through this section, you will see that while we use top-down themes to identify which parts of the market to research, the companies we have in the portfolio all clearly align with our investment criteria. For longs, we look for companies experiencing tailwinds, high quality earnings, clean accounting, strong cash delivery, and management that do what they say they're going to do. For shorts, we're looking for the opposite. Companies and industries facing headwinds, low quality or aggressive accounting, low quality businesses that are high on hype and low on delivery. This formula for picking stocks, which allows us to look outside of Australia at some of the world's best companies, has been a key driver of our success over the last 8 years, and we see it as core to our ability to perform over the next decade. Our themes broadly fall into two buckets. Existing long-running investment themes, some of which have been clear beneficiaries of the pandemic, and post-pandemic areas of focus and opportunity. Importantly, we think that many of these themes still have a long way to play out, as you will see as we talk through them. Software is eating the world. Product-driven software businesses are great businesses. They are highly scalable with low marginal costs, sticky recurring revenue streams, and deep moats. As economic activity moves increasingly online, all businesses are becoming software businesses. We use software to communicate with our clients, take payments, manage compliance, and work together as teams. We even use software to create software. We've done well out of software businesses at Totus over the years, from Altium and Tech One in the early days of the fund to Xero and Objective Corp, which has been this year's best performer in both Totus funds. You can expect us to continue owning and looking for more of these great businesses in the future. We will talk more about one of these great businesses in our stocks section shortly. The war on cash. When is the last time you paid cash for your morning coffee? COVID has accelerated a number of long-term trends, and the migration away from cash is a big one. We've owned Visa and MasterCard in the fund for some time, given their deep moats, attractive economics, and the steady migration of activity online and away from cash. These businesses took a hit from COVID earlier this year as cross-border transactions, which are high margin, fell during the pandemic, but other transactions have surged. We see these businesses as key beneficiaries of the pandemic over the medium to long term. Visa and MasterCard are our key plays on this theme. Total transaction volumes are already back to pre-COVID levels, and the return of high margin cross-border activity post the vaccines should support strong earnings growth for these businesses going forward. Iron ore cash machines. The global economy is on the mend, and Dr. Copper, a key barometer of global health, has just hit a 7-year high. We're playing this recovery through iron ore. We've owned Fortescue and Rio Tinto since the Vale Dam collapse in early 2019, but we still like those stocks here as the global economy and their key customer, China, recovers. After over-investing in the post-GFC bull market, the major miners have been a lot more disciplined about capacity expansions this cycle. As the global economy recovers, with limited new supply on the immediate horizon, there is a good chance that this cycle will be stronger for longer. Our key exposure to this theme is Fortescue, which we will talk about in our stock section shortly. In addition to strong bottom-up and top-down investment fundamentals, the iron ore exposures give our portfolio some much-needed cyclical exposure and provide a small offset to our Aussie dollar underweight, as these stocks tend to do well as the Aussie dollar appreciates. Bricks to clicks has been a big theme for the fund for some time. These businesses didn't skip a beat during the pandemic, and many actually saw an acceleration of top-line growth in 2020. We've owned Alphabet, Facebook and Amazon in the fund for some time, but in 2020 it was e-commerce that really stood out for two reasons. After years of investing for growth, profits and cash flows in e-commerce retailers like Amazon and Kogan surged as higher volumes through their networks resulted in massive operating leverage, even as these companies raced to increase spending on hiring and marketing. The second reason is that online shopping is sticky. Once you buy something online, the online retailer knows who you are, what you bought, where you live, and can market directly to you. We don't think that once you've bought your sparkling water from Amazon that you're going to fight the traffic back to Bondi Junction to fill up the car to buy that every month. A lot of this business is here to stay. Moving on to our post-pandemic themes. Stay at home, play at home. This has been a strong domestic theme in 2020, and we think it has legs into 2021. The Reserve Bank has nailed interest rates to the floor for the next 3 years, and state and federal governments are now spending hard. With overseas travel likely off the agenda still for a number of months, and house prices recovering, we see 2021 as another strong year for discretionary and household-related spending. Our play on that, and the cheapest way to play that, is through a business called Shiro, which is exposed to both the home renovation and stay-at-home spending theme through their barbecue offering. Shiro is a net cash business, has a high return on capital, pays a strong, fully franked dividend yield, and is trading on just single-digit PE on consensus earnings, which we think are seriously understated. Reopening beneficiaries. There are a number of great businesses that were impacted by COVID in 2020 and that should benefit nicely as things return to normal in 2021. One of these companies is CSL, which is a major beneficiary of increased vaccinations, not just for COVID, but also for seasonal flu. Another is Smart Group, a business we know well. The Smart Group's sales force hasn't been able to visit customers in hospitals and schools during 2020, but this will return to normal in 2021. Regulatory uncertainty around the industry is fading, with add-on insurance legislation due to go to Parliament this month. The stock is cheap on 13 times earnings, net cash, and pays a fully franked 5% dividend. According to Google, it takes an average of 66 days for a new behaviour to become automatic. 2020 has changed the way people work, communicate, travel and transact, and we think that there are a number of businesses where the current reopening optimism is overdone. As Bill Gates said, we will do some business travel, but it will be dramatically less than we have done. My prediction would be that over 50% of business travel will go away. And yet, in travel, we have listed travel agents now trading at higher market caps than they did pre-pandemic. These businesses rely on scale and volumes to drive profitability through volume-based incentives. We're now going to highlight 3 stocks of interest in the portfolio. The first of these is Fortescue Metals. As we mentioned in our theme section, we like iron ore producers and Fortescue in particular. Our process is big on cash generation, strong balance sheets, clean accounting, high returns, good market structures, and owner-driver businesses. Fortescue ticks all these boxes. For 7 times this year's earnings, which are come material upgrades at spot iron ore prices, we get a bottom quartile iron ore producer with growing production that owns its own long life mines, owns its own rail and port infrastructure. It even owns the ships that it transports its iron to China on. FY21 is half over and the market's numbers for Fortescue are 41% too low at spot prices. Consensus forecasts in FY22 would have to increase by 180% at spot pricing. In Andrew Forrest, we have an owner-driver who is focused on the long term and in the meantime is happy to return excess capital to shareholders. Fortescue provides our portfolio with a way to play the long-term growth and recovery of China in a clean, fully franked, dividend-paying domestic way. China's dependence on seaborne iron ore and an absence of viable alternative suppliers limits the risk of trade tensions impacting Fortescue, in our opinion. All roads lead to Microsoft. Microsoft is the clear winner from the global pandemic in our view. Owning Microsoft gives us direct exposure to some of the largest, most powerful secular trends on the planet. Migration to the cloud, working from home, business productivity improvement, and gaming. We think the quote from Microsoft CEO Satya Nadella on this slide is almost all you need to know. Tech spend is 5% of global GDP. We think it will double over the next 10 years, and this pandemic has perhaps accelerated that doubling. Every business is moving to the cloud, and Azure, Microsoft's cloud platform, is gaining ground on market leader Amazon Web Services. Cloud infrastructure is the largest, most secular need, and Nadella thinks that we're only 20% through that migration to the cloud. Back out $73 billion of cash, and Microsoft is trading on 28 times forward earnings for a business growing at 15%. That is not at all expensive for the world's preeminent software business and is a world away from bubble territory. Pleasingly, for a mega cap tech name, it is also out of the crosshairs of regulators for now. Microsoft is a top 3 holding in both Totus funds. Shorting has been exceptionally difficult in 2020, but fads, frauds and failures come in all market environments. One short we have identified as a fad is an Aussie small cap who has benefited from the pandemic. It makes a product that was in short supply briefly, but is now plentiful. Pre-pandemic, it had revenues less than $1 million per quarter. We know this product has low barriers to entry because multiple manufacturers in industries such as brewing and personal care have changed their operations at the click of a finger to produce it mid-pandemic. We believe that the market is now oversupplied with the product, and with the announcement of vaccines, customer orders will reduce or could worse be cancelled. An Aussie competitor recently announced a $6 million write-down of obsolete stock due to cancellation of customer orders. In the most recent quarterly result, the company's revenue disclosure suddenly disappeared and cash receipts dropped significantly. Management is highly promotional and has set expectations very high. A legal dispute with some of their distributors suggests that all is not well behind the scenes. We will now address some of the questions we've been getting from clients of late. If you have any others, please email them through and we will get back to you directly. Your net exposure has been increasing in recent months. What is the thinking behind that? As we mentioned earlier, the backdrop for risk is currently quite supportive. The US elections are out of the way and we have multiple vaccines that look promising for 2021. We should see growth returning to normal slowly over the course of 2021. Governments and central banks are still stimulating hard. As a result, we've reduced shorts, increased our net exposure and lowered our gross exposure. The 2 previous times we did this were in 2013, post the European debt crisis, and in 2017 after the bottom of the commodities bust. Both were strong return years for the fund. What if the market falls from here? Are you still hedged? We still have single stock shorts in the book, but we've been forced to be a lot more selective about them and reduce the size of many of them. However, the book still has a number of defensive characteristics. First of all, our longs are all very high quality companies, strong balance sheets, high cash generation. We still have a range of single stock short positions across a bunch of industries both in Australia and the US. Our overweight position in the US dollar acts as a natural stabiliser as the Aussie dollar tends to fall in risk-off or volatile market periods. We also have the ability to add index shorts to quickly reduce our net exposure to markets. After every party there is a hangover, and we saw meaningful setbacks post the GFC recovery in 2011 and again in 2012 as the rally in lower quality companies faded and quality companies continued to perform. We have no reason to believe that the book won't continue to offer some downside protection, but you can expect higher average net exposures and lower gross exposure from us over the medium term. How is the fund tracking in November? The fund started the month well, but the vaccine announcements saw a rotation out of pandemic winners into perceived beneficiaries of the vaccines. The Aussie dollar also kicked, which was a headwind for our portfolio. This was another example of a strong risk-on period, which our strategy has found difficult to navigate in the past. We've started to see some of this rotation fade in recent days, and we think the elastic band is quite stretched here. We don't think the growth trade is dead by any means. Just look at the recent share price performance of stocks like Tesla and Xero. How has the stronger Aussie dollar impacted your returns, and what are you doing about it? At Totus, we are stock pickers, not currency pickers, but we do acknowledge that the stronger Aussie dollar has been a large headwind for the Alpha strategy since April. Better late than never, we have started to hedge some of our US dollar exposure by selling US dollars and buying Aussie dollars. We are still a long way from currency hedged, but would use dips in the Aussie dollar to continue neutralising this bet. Another reason we like the iron ore exposure in the book is that these stocks do tend to perform well when the Aussie dollar appreciates, as they are correlated with expectations of higher global growth. To close out this webinar, I'd like to take this opportunity to thank each and every one of our investors for their support of the Totus funds and for entrusting us with their precious capital. 2020 has been an unprecedented year in many ways. It's been a tough one for many businesses and families, and a difficult one for our style of long-short investing in recent months. However, looking ahead, we're very excited about the opportunity set in front of us and the outlook for our major positions. We've been through markets like this before. The Alpha strategy has lagged sharply rising markets in the past, but has always bounced back strongly. We know the fund performs well in trending markets and during market sell-offs. The lessons of 2020 and the common sense risk management adjustments we have put in place as a result of them should lead to improved performance from the strategy after sharp market sell-offs in future. We remain confident that a carefully researched portfolio of high-quality businesses experiencing identifiable tailwinds will outperform a basket of lower quality companies facing challenges over the long term. Experience has shown us that this strategy can not only generate strong, risk-adjusted, uncorrelated returns, but it can also provide a degree of protection for client portfolios in falling markets. Sam Granger and I are available for one-on-ones or calls or meetings before year end. If you would like a meeting or a copy of the slides from today's presentation, please reach out to Joanne Couples at ir@totuscapital.com.au. We wish you and your family a very safe holiday and a prosperous and healthy 2021.